Hello everyone, this is Teacher Karen. Welcome to Business Finance class. Our lesson for today is all about tools in managing cash, receivables, and inventory. First, we will discuss working capital. Working capital refers to the part of the firm's capital which is required for financing short-term or current assets such as cash, marketable securities, debtors, and inventories. Funds, thus invested in current assets, keep revolving fast and are constantly converting cash, and this cash flow out again in change for other current assets. Working capital is also known as revolving or circulating capital or short-term capital. Working capital is current asset minus current liabilities. Under current asset, we have properties, inventories, cash. And under current liabilities, we have wages, rent, utilities, and taxes. We have here an example for how to compute current asset, how to compute working capital. As you can see, cash, receivables, and inventories, they add them all. Then also the liabilities, and then current assets minus current liabilities. 80 minus 40 is equal to working capital, which is $40,000. We have two types of working capital, permanent and temporary working capital. Permanent working capital is the minimum working capital required for producing predetermined production, while temporary working capital, it is the additional current assets required for temporary period and is above permanent working capital. Permanent working capital is all business expenditures. Its nature, it is permanent every year or month. It is minimum capital required for day-to-day functioning. Example, payment, salary, minimum stock of materials, electric, and telephone bills. Temporary working capital represents additional assets which are required at different times during the operating year, additional inventory, extra cash, etc. Seasonal working capital is the additional amount of current assets, particularly cash, receivables, and inventory. It is required during the more active business seasons of the year. It is not always gainfully employed, though it may change from one asset to another. It is particularly suited to business of a seasonal nature. This is the flow of operating cycle of the business, starting with cash, then inventory, account receivable. Cash, purchase order, which is inventory, and then sales or receivables. Okay, talk about cash. Cash being the most liquid asset is an important account in the balance sheet that will affect the liquidity and solvency of the company. A good internal control must be properly implemented to safeguard this asset. Basic internal control system entails the assignment of social function and report function to separate individuals unless you are the owner. Cash collections should be supported by official receipts which are summarized in a daily collection report. daily collection report is going to be useful for the next control measure for cash deposit collection. If all collections need to be deposited, the payments must be made through a check voucher system. There must also be 2 signatories in the check to provide a check and balance. For small payments like the fare given to a messenger, a petty cash fund is used. Petty cash fund, which should be a minimal amount, will be used to a petty cash fund custodian, say the office administrator. The petty cash fund may be 10,000 or 20,000 pesos. Disbursement from these petty cash funds must be supported by petty cash vote signed by the recipients of the petty cash. When the petty cash fund is almost depleted, the petty cash custodian will get reimbursement. Ano nga ba ang binabayaran ng petty cash fund? Tulad po ng printer's ink, refreshment, cleaning supplies, stationery, taxi fare. Yan po yung mga binabayaran. Yung mga maliliit na amount na kailangan i-cash, hindi na kailangan ng check para ipambayad. So, maliliit na amount lang. This reimbursement will go through the check voucher system, where the custodian gets a check with the petty cash vouchers as supporting documents. So, kailangan po, para ma-replenish nyo yung o ma-reimburse nyo yung ginastos nyo, kailangan po ng supporting documents. The check must also be cross-checked before drawing line in the section of the check. So this cross-checking requires depositing of a check. It cannot be in cash. This makes it more difficult for somebody who stole a check to get the money. Reasons and motives for holding cash. First, primary reason, transactional. This is the cash used for paying expenses such as salaries, utilities, rent, and taxes, and among others. Another one is compensating balance. This is the cash held to meet bank requirements such as the minimum cash balance you will pay for checking accounts. If you have existing loans, banks may also require a minimum amount of deposit with it. Secondary risk, precautionary. This is the cash maintained for emergencies such as additional cash if during political and economical uncertainties. For example, if your business requires a substantial amount of importation, a relatively higher amount of cash must be maintained. When the exchange rate becomes high, volatile due to political instability, such as what happened during Mexico. Speculative. This refers to the cash held by the company to take advantage of the opportunities by stocks during major corrections, such as what happened in the global financial crisis in 2008 and 2009, where stock valuation went down by as much as 8% to some companies. So kapag nagkaroon ng mga sales o mga pagbaba ng stocks, yung naitabi mong pera o na-hold mong pera, pwede itang bayad o ibili ng stocks na naka-hold o bumaba yung value ng stocks. Budgeting cash. So budgeting cash budget provides information regarding the company's expected cash receipt and disbursement over a given period. It is useful for identifying future funding requirements or excess cash within a given period. This allows managers to find possible sources of financing if the cash budget shows cash shortage or identity appropriate tenors for money market placement for excess cash. Normally, a cash budget is prepared for a 1-year period broken down into smaller intervals like months. This allows managers to see the seasonality of the business, which affects the cash flows. Parts of cash budget. First, cash receipts. It includes all of firm's inflows of cash in each financial period. The most common components of cash receipt are cash sales, collections of accounts receivable, and other cash receipts. Another is cash disbursement. Include all outlays of cash by the firm during a given financial period. The most common cash disbursement are cash purchases, purchasing fixed assets, payment of accounts payable, interest payments, rent or lease payments, cash dividends payments, wages and salaries, principal payments. Tax. Net flow, ending cash, financing and excess cash. The firm's net cash flow is found by subtracting cash disbursement from cash receipt in each period. Then we add beginning cash to the net cash flow to determine the ending cash for each period. Finally, we subtract the desired minimum cash balance from ending cash to find the required total financing or the excess cash balance. If the computed amount is negative, the company needs financing. Otherwise, the company has excess cash. Receivables. It is spring out of the need to sell merchandise. An excellent business proposition is to generate sales without offering a credit facility to customers. However, this concept is theoretically sound but not sustainable. Consider a real estate company which sells condominium units at 5 million pesos per unit. How many units can the property developer sell if it sells the unit only on cash basis? Do you think he can sell a lot? Probably not, as many as compared to providing installment payments. Credit management strategically defines the quality of accounts receivable collections. The collectability of accounts receivable depends largely on the quality of customers. The quality of customers depends on the standards of credit policies set up and used by an organization. Credit policies are an integral part of credit evaluation, and there are 5 C's used in credit evaluation. 5 C's in credit, we have collateral, property type, location, or marketability. So collateral, the person who will buy the property, you have or going to a credit. The first C is collateral. Next is credit. If the person is no credit at all, other companies. Issues with explanation. Okay? And then capacity, ability to repay loan. Okay? So ability to pay loan. And then capital, maybe the down payment or the down payment source. Then character, willingness to pay loan, integrity, and stable employment. Those are the 5 C's. Proper management of accounts receivable entails having a good billing and collection system. Good system should lead to the sending of statements of account to customers on time. Inventory management. It involves the formulation and administration of plans and policies to efficiently and satisfactorily meet production and merchandising requirements and minimum costs relative to inventories. Effective inventory management becomes critical when the nature of products are perishable, fragile, or toxic. Involves the determination of receivable levels or inventories considering the size and nature of business. Maintaining too much inventories has costs such as carrying or holding costs, possible obsolescence, or spoilage. On the other hand, low inventory can result in stock out and inventory loss sales. 3 types of inventory. We have raw materials. These are the purchased materials that get put into a production. Work in process. These are goods and labor put into production but not yet finished. And 3, finished products or goods. These are goods and labor put into production and finished. These are ready to be sold. Okay, so before we end, let's have words of wisdom. The wicked borrow and never repay, but the godly are generous. Psalms 37. So thank you and God bless. Stay safe. Bye-bye po.